Next, we're going to transition into a series of panels, and I have to tell you, I'm thrilled to have such a remarkable and diverse set of panelists. I'm sure we're in for some great sessions. First up will be a panel titled, Not Your Keys, Not Your Coins. This panel explores how MPC is transforming the concept of digital asset ownership and control. The panel is moderated by John Salmon, a technology partner at Hogan Lovells. John is a highly experienced technology lawyer, and he's been advising on digital and online issues for more than 20 years, with at least 15 focused heavily on fintech. John, thanks again for moderating today, and please introduce your panel topic and your panelists.
Thank you very much, Frank, for that introduction, and thank you very much for attending this panel. So I'm going to let the panelists introduce themselves, but just to start off with some context, the purpose of this panel is to focus particularly on some of the legal and regulatory business issues around multi-party computation, in particular the challenges that this brings to the world of crypto assets. I know that all the panelists are very used to the challenges we've already got in the world of crypto assets, and is it an asset that can be owned? How does one custody it, etc.? Who takes responsibility? So I think MPC just adds a further layer of complexity. So very interested to get into these discussions. So I'll just go around and ask the panelists to introduce themselves, and also just to answer the first question, if I may. So the first challenge I think we have on crypto assets is how do we define and relate to ownership of crypto assets, because crypto is different from money, it's different from traditional shares or bonds. So it is a new thing that I think regulators and policymakers around the world are struggling to get to grips with. So I think maybe just starting with, how would you see ownership of crypto assets? And I appreciate we're all from slightly different jurisdictions as well. So I'd be interested in your perspective, so that we can then overlay the MPC onto that. So I'll go around in the order that you guys are on the screen, if that's all right. So Oren, would you mind starting, please?
Yes, of course. So my name is Oren Goldberg. I'm leading the solutions architecture team in Firebox. I've been in Firebox for about a year and a half now, just over a year and a half. I came from a background of research and development, specifically offensive cybersecurity. I've done some vulnerability research in my past, core development, backend development, and then I decided to switch my role and career to something that is more customer facing. And this is my role as a solutions architect in Firebox. I mostly work with the largest financial institutions in the world, of giving them the ability to integrate with an MPC-based wallet infrastructure such as Firebox. We're working with them hand by hand to tailor our solution and really to deploy a successful infrastructure on their end. And I think the biggest revelation in MPC is that it transforms ownership in the way that it basically allows the operational and easy operational usage of the MPC key shares themselves. Technically speaking, MPC or wallet ownership is defined by who holds the private keys, whether they are complete private keys in a single form or distributed private keys in their share forms. And this is something that our wallet infrastructure does really well, and something that MPC gives an answer to in terms of security and operational usage.
Great, thanks, Oren. Adam?
Yeah, hi, folks. Adam Fleischer. I'm an attorney with Cooley LLP, located in Washington, D.C. Primarily focus on all manner of non-bank payments regulatory matters, which in the United States is the state money transmission laws and the Federal Bank Secrecy Act. These legal regimes predate, of course, cryptocurrency activity. But because the concept behind these laws is acceptance, holding, transmission of value, they have been to some degree adapted, or as I can tell clients a lot, the square peg of these laws is being pounded into the round hole of crypto to try to think about how to regulate this new way of moving and storing and handling value. The certain term ownership, it really sort of, it's almost beside the point from the regulator's perspective. I think it's consistent with what Oren was saying, in the sense that what we really find is who's controlling, who has the ability to control the underlying asset, and who has the ability to facilitate the movement of that asset. So in terms of the regulations, to the extent they have been adapted to cryptocurrency activity, either expressly through statute or by regulation, it's really using the old terminology of traditional money movement, which to John's point doesn't really fit, but this notion of receiving, holding, custodying, controlling, transmitting value. So that's a good place to start, and we come back around a bit more on what that actually means in terms of private keys and some of the other questions.
Great, thank you, Adam. Jeff?
Hi, everybody. Thanks for having me. Jeff Banman, my own consulting and advisory firm, Banman Advisors, where we work with businesses and governments to help work with kind of changes and evolution in business opportunities, primarily in fintech, blockchain, and crypto assets. I also have a background in financial regulation. I was responsible for initially blockchain task force and crypto asset working group, which then became Lab CFTC, the one of the first regulator innovation hubs looking in this area. And before that, I was a financial services lawyer in New York, and then worked in financial services in New York and London. This question of what is ownership in digital assets, as Oren and Adam sort of indicated, there are so many different areas of law and regulation, and kind of both the meaning of that term and what it's relevant for can be quite different. And so, Adam, for example, was referring to kind of concepts of kind of control or custody when it comes to money transmission that are often very important, either for a user protection, but also particularly for anti-money laundering perspectives. Regulators look often very closely at custody issues in the context of exchange. It can be very relevant for tax. A project that I've been very focused on, among others, for the last probably year and a half, has been working with the Republic of Cyprus in the European Union on a national umbrella law relating to blockchain. And one of the things that is part of that is actually looking at this not from a crypto asset regulation perspective, but what is the nature of property rights under, and under what circumstances will a court recognize that a person has a property interest in a crypto asset? Does the court have an obligation to respect evidence on a blockchain? In what case can that evidence be rebutted? And as it turns out, as part of the analysis for this, looking around to jurisdictions, not too many jurisdictions in the world have actually defined the nature of kind of crypto assets as property, whether it's intangible property or not. And property and ownership definitions are typically a matter of the law of a particular jurisdiction. So unlike other areas of law, like anti-money laundering, where you have international standards that may also be applied to AML and custody, may be different. So this opens, I'd say, a real Pandora's box of potential questions.
Thanks, Jeff. Oriel?
Hi there, thanks for inviting me. So I'm Oriel, I'm the CEO of Zango. Zango is a retail crypto wallet, non-custodial and based on MPC technology. We allow anyone to create a non-custodial wallet in a few seconds without the help of private keys or even passwords. And we handle multiple blockchains and various financial services, from buying, selling, trading, etc., etc. And about the question of ownership, for us, ownership, so we're looking at it from a user point of view, a retail point of view. So this is the lens of expression that we have here. Mm-hmm. And we're servicing hundreds of thousands of users. So we've had the opportunity to think about that question a few times. So ownership first means that it's a public ownership, meaning that it's publicly verifiable. An ownership of a digital asset is a digital item that is associated to a public key and that anyone can verify. That is a radical switch and difference to the traditional systems that we've been accustomed to in Web 1 and Web 2, where assets sit on private databases. And the only way to verify that you actually own it is to actually be the operator of that database. And so for the first time in history, there is a way to do that publicly without the need to have a third party testifying for it. And I think that's the beauty of public ownership, and the term public ownership, both words matter. The second characteristics, in our opinion, I think many would agree with that, is that ownership is defined by what the owner is capable to do alone without the help of anyone else. And so that applies to at least three dimensions. Can they start a transaction? And only them can start a transaction. No one else. Not the operator of a database, not an exchange, not a bank. Can they define alone the parameters of that transaction, right? How much they're sending, who they're sending to, and what coin they're sending and what amount. And can they control and stop that transaction even once it's broadcasted? So I think those are really things that define ownership in the usage of those digital assets, and not just as the concept of what it means to own. And I think it translates into actions about what the users are capable of doing. And I think on-chain ownership, public ownership, enables those characteristics and are very, very important to build the digital economy, the Web3 economy.
Thank you. That's really helpful. Gabrielle?
Hi, I'm Gabrielle Patrick. I'm the CEO of a fintech called Nabu, and we are licensing to be a clearing bank here in the UK. I've been a lawyer for a little bit over 20 years here in the UK and in the States and one or two other places. And I'm probably most known for licensing one of the first payment solutions using crypto here in the UK that was classified as a payment system a couple of years ago. I think I want to just echo what everyone has said on the call. The concept of ownership in crypto land, not only does it revolve around custody, I think we've all said it in different ways. I think the true challenge with the regulators to date is not the concept of custody and control, but how they define it, because it's a different paradigm, it's a different way of thinking. I think Oriel had expressed that in a very sophisticated way. That concept of public ownership and public verification is just a total shift in terms of traditional financial services thinking. And I think one of the things that most regulators have not thought about is not just what is the definition of ownership, but how is the ownership proved? I believe what Oriel was getting at is, there have been a number of legal cases where it really comes down to, can someone initiate the transaction autonomously? And I think because regulators can't understand, or traditional people cannot understand the concept of public ownership, this is why we're having this type of conversation. It really is quite new and cutting edge. And I think when you're in the industry, you kind of take it for granted that some people are still living in 1995.
Or 1985, Gabrielle, in some cases. But no, I totally agree. And I think that's very helpful. I mean, I think just moving this on to the context of MPC and how this might change. And I think maybe just given the interest of time, looking at how, in particular, MPC interacts with custody of the keys and the assets, because that's, I think, a fundamental problem that certainly I see in my day-to-day work with crypto exchanges and with global banks who are looking at custodial wallets or custody of assets or whatever, because I'm sure many of you will have been the same, but having been very boring and gone through how different regulators and policymakers look at custody of crypto, some of them will talk about custody of the keys, some of them will look at the custody of the underlying assets, but usually they say and or just or, because they don't really know what they're trying to get at there. And maybe Gabrielle, you could start with, if you don't mind, because we'll back the other way. That question of, custody of crypto and what, in your view, we should be looking at, and also particularly overlaying that with MPC, because I think that creates another layer of complexity, doesn't it? That I think will be hard to explain to regulators.
Okay, so maybe this is controversial. I actually don't think it's complicated. I think MPC is simply a way of sharing data in a reliable way with computations where there's various inputs are not shared with other parties. That, for me, I'm not a cryptographer, but that's not a complicated concept. The problem you're describing with the regulators, which in my opinion is quite acute in the UK, is simply that they don't want to be committal. They're kind of straddling the fence. And so you have a situation where I believe to date there have been 900 or 700 to 900 companies applying under the new crypto asset regime here in the UK, of which I understand 35 have been licensed, right? So for me, a multi-party competition, I'm sorry, is just an evolution of cybersecurity and security generally of data. It's not a complicated concept if a regulator or an authority follows the lead of what Oriel was describing of publicly verifiable transactions.
Yeah, I think where regulators and policymakers, and I don't want to pick on them, especially since Jeff was one, right? But I think where I've seen certainly them struggle is trying to work out how to apply, and it's not necessarily completely their fault, the traditional rules of custody to crypto, right, in terms of the keys versus the assets. And I think if we say, oh, and by the way, the key is going to be split in terms of control by, in XYZ parties, I think that might make their heads explode, to be honest.
I'll just add something quickly without dominating the conversation. The internet has several gaps which 30 years later regulators have still not fixed. So why are we on the call? Because crypto is valuable, because it's useful, because people use it. So my thesis is with value comes taxation. And with taxation, regulators tend to figure things out really quickly. What's happening? We're just at this inflection point where they're beginning to understand. So I don't think it's something that is going to be lost in them for too much longer. They're going to figure it out one way or the other.
Yeah, my experience, Gabrielle, I don't know if everyone else agrees with this, is that in crypto you can see the waves, but the first wave is that the authorities figure out how to tax you, then they figure out AML, CTF, then they figure out the next levels down. You can see that, and DeFi is now the next, whereas NFTs will be next year's problem, I suspect. Oriel, sorry, what's your kind of take on this?
Well, again, I'm trying to look at it from a consumer point of view. At least I think that's what the color that we can bring it, because there are extremely knowledgeable people dealing with institutions. So it's going to sound a little bit silly, but we try to make that something that the consumers should not worry about and should not even understand. We make this complexity of MPC completely go away. The enormous majority, if not all, our users, and I think, are not aware and should not be aware that we're using MPC. What matters, though, I think, is what are the properties that we're able to extract from MPC so that users can actually enjoy that technology in a very particular way. And so, again, it's back to not so much about the notion of custody, but who controls what, who is in control. And so we like to call it user-controlled wallet versus like self-custodial wallet or non-custodial wallet or whatever you want to call it. And so what does that mean that the user is in control? It means that he is in control, that he really is in a unique position to start transactions, to do certain things with the wallet that no one else can do for him. With a particular color is that since the security is distributed and the notion of distribution of roles and responsibilities matters here, the distribution of the security provides additional guarantees that you do not have usually with typical custody, right? Where you basically becoming your own CTO and OPSEC officer. And so many people don't want that, don't know how to deal with that. And so you can be assisted for certain critical operations, for example, for the case of recovering the wallet or delegating certain responsibilities. And I think to me, what really matters to understand here about MPC is not so much whether to look at it through the angle of custody, but what it enables in terms of properties, in terms of functions, in terms of features, and in terms of responsibilities. And we are faced into it because we built a consumer product, meaning we are seeing firsthand how people are using the technology. And so we don't have to guess how people think about it. We observe it on a daily basis, tens of times, hundreds of thousands of times, and in a very high frequency. So that's how we're thinking about this concept and how we think it should be understood, or better said, experienced by the users.
So you in your view, Aurel, in your experience, this is really interesting, the people don't worry about MPCs as such, about whether it's MPC, but are you transparent in what you do with the key and how they can control it and how they can, and who can do what?
Yeah, in other terms, what matters is the experience, not the tool, right? The famous Steve Jobs is not how it looks, but how it works, right? This is design. And so to us, what really matters is that a user can go from zero to crypto in a matter of seconds without having to deal with all this complexity and overhead of backing up and writing down and becoming an OPSEC manager and worrying about what happens if he changes his phone or his computer, all these kind of things. The experience of that really matters. The experience of the recovery matters, and the security that goes from A to Z matters. And so I prefer to translate it into consumer benefits versus technology properties.
Thank you. Jeff?
Yeah, sure. Well, I think that, for the points that Gabrielle and Aurel have been making, I mean, there's no question that, for many people, kind of exercising and, deploying, let's say, the full scope of powers that crypto, enables, it can be quite daunting for people. I think that the consequences of, making a mistake, is being your own OPSEC person is something that, is quite daunting for people. And so, I think that the potential or the promise of introduction of, something that, lets people exercise those rights and freedoms in a way that's more kind of manageable and accessible, is something that is going to be, very, very attractive. I think, again, and, I agree with your kind of observation earlier, John, that typically, the first two things are tax and AML. I think AML, I would have said AML comes first and tax comes second. But in either event, if Adam has an account at Coinbase or Kraken or FTX or wherever, and has a gain in that account, even though Adam never had custody or control that it was always there the whole time, from a tax point of view, that will be viewed as, his gains or losses. If he sends it somewhere, I think part of what we're seeing in this space is that these concepts, that all the speed and pace of innovation, are really, challenging things for both regulators and legal systems. But, I think that, one of the things is that kind of traditional notions of ownership or property, can there is a conflict in the sense that like somebody else could have, asserted control, whether it's the Dow attacker who's recently been exposed, or someone else could exercise the powers and authorities that Oriel was talking about, but that could be somebody who has wrongfully obtained those things. And so, courts and legal systems may define property otherwise. We have customs of third-party custodians, we have bailments, we also have delegation of rights, which is, I think, becoming particularly important with NFTs when you want to sort of vault an NFT, but you need to sort of be able to prove that it's yours so that you can vault it. So I think these technologies are quite critical. And I guess the last point I would say is that, I think, kind of this group, our group of discussants seems to be on the kind of the leading or bleeding edge. But I think, educating, policymakers, legal systems, courts is going to be critical, to promote some of these new concepts.
Agreed. Thank you, Jeff. Adam?
Sure, John. I think, just to very quickly step back, all of financial regulation before crypto was the regulation of the intermediary. Always needed to be an intermediary between party A and party B, or to service party A for its financial needs. And that's been the regulated entity. And now that we all use the phrase intermediation. And so I think it's caused a bit of a fracturing in how the regulators approach this, in the sense that in the United States, at the state level, primary concern of regulation is safety and soundness, prudential standards, customer protection. And maybe this telegraphs my next comments or the next discussion, but to the extent the regulators have come out anywhere so far on this, it's that if an intermediary doesn't hold the private keys, can't control the transaction, it's not a financial intermediary, it's a software provider. It provides functionality to hold a wallet or to hold keys on your own device. I think that's almost sort of like the answer, and it's not quite clear, and maybe folks will have a reaction to it, how new technology for key storage that doesn't change the control that the quote-unquote intermediary has, how that would necessarily affect that analysis. To put another way, it may not affect that analysis from the regulatory perspective. However, at the anti-money laundering level, the other key element of financial regulation, or regulation in general, U.S. regulators' insight, which I don't think is an unreasonable one from their perspective, is that anybody that can make a transaction happen, that can control the transaction, if it's an intermediary in that sense, is responsible for anti-money laundering compliance if nobody else is. Or to put another way, if there's nobody else, if it's just a disintermediated transaction, but there's a software writer or a software protocol writer or someone who takes a fee for that transaction, then that sort of person is the last man, last person standing, last entity standing, if you will. And that will be the regulated entity, because there cannot, almost to a default, and I see Gabrielle nodding along here, there can almost to a default be an unregulated transaction from the perspective of anti-money laundering compliance. If value is going to move, there needs to be somebody responsible for the movement of that value. And so I think it'll be very complex when it comes to more diffusion of control of the transaction for industry and for regulators to identify somebody as an intermediary who's responsible from that AML perspective. And I put that out there for others to react to as well.
Gabrielle, were you going to say something?
Yeah, I was just going to say that, Oriel's expression is how I feel, similar to RN, which is that, Zengo has built a business from nothing, so have I. Fireblocks is awesome. And so you have this disproportionate view of the regulators where a lot of them are non-committal. And to Adam's point, yes, there needs to be someone who is accountable if you're providing a service. You must be a quote-unquote good actor and not allow bad actors into the system. But at the same time, it can't be heavy-handed AML compliance burdens, criticizing us for not doing everything to the letter of the law in a traditional financial services system, and then want to pat us on the back as innovators. I mean, how does that work? So for me, some of the US states, not all of them, New York has been disproportionate. London, they have their own issues. And then, if you look at the macro picture, for me, the benefits of MPC and cryptocurrencies in this new paradigm is it's something that the people can use that works. That's where it all stems from. It's something that can work, and Oriel, I think he says has something like 800,000 users or something like that. That's magnificent in times when we actually seeing the traditional financial system, in my opinion, collapsing. It works. We could send funds through a bank. It's not that it doesn't work, but the question is, does it work optimally? And does it work for the people who are not rich, the people who just have, need to send microtransactions? So it's just a long, convoluted way of seeing that. Yes, I agree that as software providers, we must have some level of accountability, but the question is it proportionate?
Yeah, I agree. I think the key word there is proportionality, and I think some of what's come out of FATF and other regulators is definitely, in my view, is certainly not proportionate. But anyway, sorry, Oren.
Yeah, so I'll take the perspective of the technologist. So basically, ownership from a technology standpoint, it simply means who has access to the private keys, whether they are, single private keys or private key shares. And MPC really, if we think about it, it's not the first generation of a signature threshold mechanism, right? It's not the first protocol that allows for distribution of keys. I think that the previous generation or the previous evolution step in signature threshold mechanisms is multisig. We've known it. It was used heavily by the crypto financial market for years. And then we saw the surgence of MPC as what is now, I believe, for what we see currently is the market's standard, right? Every wallet provider and every consumer expects their wallet provider to use something that is at least secure as MPC. I think that the benefit of using MPC is, from a technology standpoint, ease of operations. You can change the governance layer of ownership on the go without having some major implications on the structure of the wallets themselves, without relying on changing some states with paying enormous fees on the network. And really, MPC is a cryptographical protocol that is independent of the blockchain that it's used on, right? MPC can be used on ECDSA, EDDSA, or whatever protocol it is, and it simply allows you to easily distribute the keys into multiple key shares, and this is basically the shared structure of ownership that is defined or as defined by the regulators. And I think it's not just MPC that the regulators are looking into. It's the, let's say, the other part of the infrastructure or the other sides of the infrastructure, such as the governance layer, the approval structure. And really, I'm going to contrast what Uriel said a bit, but for us as a wallet infrastructure, ownership doesn't necessarily have something to do with a creation of a transaction, because you can always initiate the transaction. It's a matter of fact who can co-sign or complete the signature of that transaction. Because again, ownership means who has access to the keys, and what is crucial for the regulator from a technology standpoint is to do their due diligence on the risks and on the mitigations on how the wallet provider securely stores these MPC key shares, whether it's storing them on their cloud infrastructure, whether it's distributing them through multiple cloud providers, whether the custodian or the what we call the self-hosted custodian uses on their infrastructure. So this is what we see in the market, and also with insurance companies, right? It's not only regulators, but insurance companies need to provide insurance policies as well.
Yeah, no, that's a very good point, Oren, and that's thank you very much. That's been a really very interesting conversation, and one that I'm sure we could do for twice the time, but I'm being told that we need to wrap up now. So thank you once again, everyone. Thanks, Oren, Adam, Oriel, Gabriel, and Jeff. Really, really interesting discussion, which, as I say, could go on for another hour, I'm sure, quite easily. But thank you very much, everyone, and thanks very much to the organizers for inviting us to do so.
Thank you.
Thanks so much.
Thanks.
Thank you.
Thanks, John, and the entire panel. I knew that was going to be a great panel, and I only wish we had more time to continue that discussion.